Welcome to Kaizen Time, part of the Blood, Sweat, and Business podcast, where we provide constant improvement to businesses through timely, actionable financial solutions. Do you want answers to your financial questions? Email us at bsp@kaizencpas.com. I'm your host, Mark Valesky. Now let's get started. Welcome to another episode of Kaizen Time. I'm joined by Eric Jorn, a partner here at the firm. What's going on, Eric?
Oh, summer. We got nothing to do, right? We sit around all summer, wait for next tax season to get some more tax returns done.
Yeah, but in September, that's when things start picking up with that pre-tax, right?
Oh, yeah, quarterly estimated tax payments. No, actually, and that's a joke. We work with our clients year round, so we are busy
constantly have stuff
year round. Yep, and our tax seasons aren't as crazy as they are for most firms because of that.
Well, and in a previous podcast, I talked with Brian, and part of that also has to do with the integration with YPD as well. So that's a huge help for everyone. Everyone benefits.
Absolutely. We love that integration because if we need to make something happen for payroll purposes, guess what? We just let the people downstairs know and they make it happen instead of you as a client having to go back to ADP or Paychex or whoever your payroll processor is and go and translate what we discussed and execute it. You don't have to do anything. You just have to agree with the plan that we put out for you, and it's up to us to go execute it. It's an ideal situation.
Yeah, well, it makes sense, too, to have all that information housed in one location.
Absolutely.
And now let's talk about some housing, specifically real estate. So maximizing tax deductions for real estate. Now, we're talking specifically for businesses.
Yep.
How does that work? What should you be doing?
Yeah, so right now we're in the midst of planning season, and what are the topics that come up? Either I've bought real estate throughout this year, or I'm going to buy real estate, or we need to find some tax deduction somewhere and something that you have going on.
I didn't notice you say anything about selling real estate.
Does
nobody sell real estate now?
People do sell real estate, and there are aspects to selling real estate. We'll touch on a very small part of selling real estate and the tax aspects and how this parlays with one strategy that we're going to talk about today, which is cost segregation.
Now, cost segregation, that's been brought up on previous podcasts. You want to go into that first and what that is?
Yeah, definitely. So if you should go back and listen to our podcast with the fine folks from Alternative Tax Solutions. We're actually working on a cost segregation study right now with them as we speak. But what is cost segregation? So you have a building, you have a commercial building you bought, let's just say it's our office here at the firm. So traditionally, if you don't have a study done, you have effectively two assets. You have land and you have the building. Land's non-depreciable. The building's depreciated over a snail's pace of 39 and a half years.
39 and a half years. How did they decide that? Just somebody rolled a dice and said 39 and a half?
Government legislation at its finest.
All right.
Yeah, so you're at 39 and a half years for, say you bought a building for $1 million, 200,000 worth is land. The other portion, the 800,000 is your building, and that's depreciated over, we'll call it 40 years. So you get a $20,000 a year deduction for your $1 million investment.
Okay.
It's a good chance those tax deductions aren't going to match cash flows if you finance the property, and it's really not going to move the needle, right? So if I go out and I buy a piece of $1 million real estate, thinking that's going to help my tax bill, not really going to happen. But there's a trick to it. We can do a cost segregation study. So we still have our 200,000 of land. I can't change that. Mm-hmm. However, we work with a firm that brings in an engineer. The engineer goes around the property and they identify various different parts of it, right? We have driveways, we have framing, we have roofs, we have AC units, we have furniture, fixtures, various type, maybe even equipment that came with the building. And here's the thing is, while the building itself, the framing and all that stuff is still going to be 39 years, the furniture, fixtures, equipment, things like that,
those depreciate a lot faster, don't they?
They 5 to 7 years, and we can accelerate that, meaning we can take Section 179 depreciation and take it all up front.
That sounds really convenient in many ways, especially when you need certain funds available.
Absolutely. And there's a reason why I threw out the $1 million building. because that's when the benefits really start outweighing the cost of having one of these studies done. One of these studies is probably going to cost you somewhere from $5,000 to $10,000 to have that done. So a pretty sizable investment, but maybe $1 million building could yield you, let's say, 100 to 150,000 in acceleratable depreciation. You're in a 35% tax bracket. That's anywhere from 35,000 to 52,000 in tax savings in that initial year.
So really, it's just kind of moving the needle wherever you need it to be.
Absolutely.
That's great. All right. So cost segregation is one of the big ones.
Yep.
What else would you say?
Well, there's a lot more components to cost segregation.
Oh, really?
That we can dive into. Yep.
Go ahead.
Yeah, because we talked about it in the year in which you purchased the building, right? You can also do it if you build a building, right? You build it from scratch, and you can work with your builder and the cost segregation team to make sure that we have as many deductions acceleratable as possible, if that's a word.
That sounds wild. Hey, I need to build this building, but also I need to make sure that I'm getting money back from it.
Yep. Absolutely. Yeah. How can we maximize the benefits of something that we need? And right, we've talked about this on the podcast before. Should I own my business as real estate?
Yep.
And it's almost always a resounding yes. So let's take that great investment, right? Your business is going to cash flow you acquiring this piece of real estate. Let's maximize tax benefits. But there are some pitfalls. So rental properties have a different tax treatment than your operating business. So say I have a loss in my real estate because I did this cost segregation study. I found $150,000 of expenses. We set up our self-rental arrangement to zero income based on rent and just expenses of the building. So we broke even there, but now we found another $150,000. So I have a $150,000 loss on my real estate and say I have a $500,000 profit from my business. Well, those things will not be able to just offset each other.
Correct.
Because you have real estate's considered passive, business is considered active.
Makes sense.
So how do we work around that? Right. We want to utilize that. We want to offset that. So there's a few different ways. So if you're doing an initial construction or build out, right, there could be a larger upfront rent payment or initial investment from the operating business that needs to go onto or increases the income. So maybe it is that $150,000. Of course, we got to make sure whatever we're charging is reasonable, ordinary and reasonable, to not make this only a tax play. You have to have actual business purpose to move to setting up that arrangement. And there needs to be an agreement or something that dictates that this is happening and this is why it's happening. But that's one way to do it. Additionally, maybe there's equipment that was part of that real estate purchase that really should be an asset of the operating business. Okay. So how do we get that equipment as assets of the operating business?
So for example, you build a warehouse and you decide, hey, these forklifts, they can stay as part of the business.
Yeah. I'd probably say more likely pallet racking would be the most likely item. The forklifts should be executable, but you never know, right? The warehouse could have their forklifts in there and you wrote one big check for your real estate purchase and we got forklifts sitting here.
Okay.
So, one of the best attributes is you probably own your real estate in a LLC or a partner, sole member LLC or a partnership, which means I can take assets out of it and contribute them to my S corp and then distribute them. So there's tricks. There are some tricks that you can do to shift things around.
Let me ask you something, Eric. You said 39 years of depreciation.
Yeah.
Right? So does that reset when there's a new owner that comes into play?
Yes.
Wow. So in reality, if you're playing the game every 39 years, you're like, time to move.
Yep. You could do that.
Okay.
But what happens, right? You're selling your building.
There's a cost to that, right?
There's a cost to that, right? Because I got all those deductions up front, right? We wrote that off. $1 million building, say we wrote off $300,000 of that $800,000 value we talked about early. And now I sell it for $1.5 million. right? So you're like, oh, I only have 500,000 of capital gains, which is correct.
Okay.
But we also depreciated. We took write-offs on that $1 million base by 300,000. Now we have to, and we sold it for more than the depreciated base.
See what's going on.
We have to recapture depreciation.
So in many ways, you're like, oh, maybe I should just sit on it.
Yeah.
But again, that's a conversation that you should be having with your accountant before anything, right?
There's two ways to combat that, right? If you want to move, you can do a 1031 exchange. So you can go buy another building, sell your building. When you sell this building, the money sits in a suspense until you acquire the other building. There's a lot of stipulations on how to execute that, and you have to work with a third party to hold the money in escrow until you buy that other property and you close on that other property, and it has to be worth more than the property. Otherwise, you have something called boot. We're not going to do a deep dive into that. The other one, obviously, is you hold the property till you die, and somebody inherits that property. When you inherit real estate or you inherit any assets, it steps up to fair market value. So we'll say the sins of past get washed away in that case. All of a sudden it's worth your $1 million building's worth $2.5 million. You pass it on to, say, your kids, and they success your business. Well, guess what? I now have a $2.5 million basis property that I acquired completely tax-free. And guess what we can do on that again?
Depreciate it.
Cost segregation study again.
Huge.
So it's a nice play. I mean, and this is what a lot of the larger, when you hear about people wiping out their taxes, right? We'll use the Donald Trump scenario. How does he do it? Right. Well, there's a good chance he's buying a hotel, and you do a cost segregation study on a hotel. There's a lot of depreciation that's happening.
There's a lot of foot traffic in there. It's being used often. Yes.
Yep. So that's likely one of the ways they do it. And they also have tricks where they don't use earned income as a source of capital for whatever they need to do to live. So they have a lot of plays, but they also have unlimited access to capital, and that's why they can get away with paying no tax.
So what else have we not touched on with these deductions?
Yeah. Let's talk about one other nuance, right? So you have to do a build out on your property. Build out meaning I have to remodel something, or
there's an addition.
We're going to do an addition, something along those lines. There's something called qualified improvement property that's available to the lessee, not the lessor. Lessor means the property holder. Lessee means the business.
Okay.
So obviously, if you own both, you wear both shoes.
You're in a great spot then. Yep.
And one of the issues we'll see from time to time is people will put those improvements inside of their real estate holding entity, which defaults then to 39-year depreciation.
Okay.
Whereas if you do it inside the operating business, it's qualified improvement property, 15 years, eligible for Section 179 accelerated depreciation. Some things maybe have to go through bonus, which is a little bit less, but a lot more opportunity, a lot more flexibility to get immediate tax benefits.
Okay. Yeah. You don't have to wait for those 39.
Yeah.
You can just kind of speed it up in the 15. That's
exactly.
Nice.
Exactly. Yeah. Not just speed it up in 15, but where Section 179 grants us the full deduction up front.
Oh, wow. So especially when you need some liquid cash fast.
Yep.
Get you through a tough time.
That'll get you tax savings right up front like that. Especially if you say you finance the build out, you get the immediate tax deduction. You could theoretically infuse some capital back in your business that way. And the big thing why we talk about accelerating depreciation is because a tax deduction today is worth more than it is tomorrow. Except in maybe cases in which maybe an expense can straddle a year, right? I have a really low tax year, a really bad year.
Your bracket.
And we're at 10% income tax, but next year I'm going to be at 35%. Different scenario. That's why we plan. Yep. We would not do a cost segregation if you're in a 10% tax bracket.
Yeah. Yeah. Right. Gotcha.
But we do it for sure when you're in a 35% tax bracket.
Makes sense. A lot of this goes back to planning.
Planning. Exactly.
Perfect. Anything else, Eric?
We talked all about business real estate. You can also use this on other investment real estate that you might have. So say you have a rental property. Popular use is I buy an apartment complex, maybe a $2-3 million apartment complex. Again, all those individual units will have a lot of fixtures, a lot of maybe even equipment. Also good candidates for cost segregation. That key dollar amount you got to think about is $1 million property or greater. So single family home, probably not. There's some DIY software options out there that are really affordable to do it, but we don't think those would hold up under an IRS audit because it doesn't fit the guidelines.
And really, it is kind of designed for business.
Exactly.
Perfect. Thank you so much, Eric.
Thank you.
You've been listening to Kaizen Time, part of the Blood, Sweat, and Business podcast. If you like what you heard, subscribe and leave a 5-star review. This podcast has been brought to you by Kaizen CPAs Plus Advisors, providing advisory and accounting services to help you grow your business. Learn more at kaizencpas.com or email us at bsb@kaizencpas.com.